Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video I'm going to go over 5 different companies that have increased their dividends recently. But before we get to that, I would like you to do 2 things. First of all, like the video, subscribe to the channel. Of course it doesn't cost you a penny, and of course it helps the channel massively. And the final thing is to look at join us hopefully on the Patreon account, where you get access to all the buys and sales, the Sharia compliant investing ebook, all the dividend calendars and all of that stuff that's in there. Now the reason I want to talk about today in dividend, the companies that I want to talk about, is because I do really enjoy companies that grow that dividend. And this is one of the reasons I came across this article a couple of days ago, and inshallah I will be sharing some of it with the community basically soon. But this part here is basically for me the most important part that kind of summarizes the reasons why dividend growers are really important. And they've talked about here basically the benefits of dividend growers, and basically having them in a diversified portfolio. They talked about dividend growers have historically outperformed basically than actually non-dividend paying companies or non-dividend growers. And with less volatility, that means to me that's really important, because I don't like having companies that have a higher volatility or high beta, if you like, which means they can go down 5-10%. If the market goes down 5%, I don't want the companies that I own to go down 10-15%. And high volatility that's basically what it does. So companies with persistent dividend growth have provided competitive returns during periods of market volatility. So if we see something like what's happened in 2022, where the companies in the S&P 500, that technology companies, come down quite a lot, this can support us. So if you have a dividend growth portfolio and basically a diversified one, inshallah hopefully it wouldn't be as volatile as the rest of the market. And with inflation still being high, they've talked about dividend growth oriented portfolio might provide a slight hedge against rising costs while providing an attractive level of income with potential for growth. And again, that's really important, because if we are still in the interest rates is still high, that might basically companies like this that pay that still increase your basically dividend every single year will give you that attractive level of income, inshallah, in the long run, which you can then reinvest into the portfolio. Because remember, when the stocks go down quite a lot, you're not going to sell those companies. But if you get in to make a profit, you're not going to sell it basically companies that are down 5-10%. But because if you need the income, that is. But these companies are actually increasing their dividends, even though we're in a recession, the interest rate is high, this and that. They still increase it by 5%, 10% every single year, which then means some of these companies will give you returns that are actually better than the inflation itself. So it is important to me to actually have some sort of dividend growth companies in my portfolio, and that's what I try to do. And what I want to share with you guys today is 5 companies that have increased their dividend recently. And unfortunately, a lot of these companies are now overvalued. So I'm hoping, and I genuinely hope for a market correction in the next few months. Because right now, everything, I'm looking around and I'm trying to find good companies that I can share with the community that are still undervalued. Of course, there are some out there, and inshallah, I will be sharing with you guys soon. But right now, everything seems really expensive. So just be mindful. And, right now I'm concentrating on the companies that I own already, and just trying to see value in those companies that are still, they're in the portfolio, inshallah. Anyway, the 2 things I want to focus on is the latest increase. So how much they've increased that dividend, as well as the free cash flow. Because free cash flow is how they support that cash, right? And the first company we're looking at is Eaton Corporation. This is an industrial company. They have 119 billion market cap. It has a narrow economic price right now is $297 per share. Dividend yield of 1.26. Payout ratio of only 38%, which is nice. So the latest increase was 9%. So if inflation right now is, for example, 8%, 9%, or even lower than that, then this company is giving you more, okay, which is quite nice. So inflation beating growth in terms of dividends. The 5-year growth rate is only 5%, and dividend streak of 14 years. So they've increased that dividend for 14 years without cutting it. The annual payout is $3.76, And safety right now is 85%, profit margin of 13%, return on equity 17%, and return on invested capital of 13%. Free cash flow, like I said, is important because that's the money the company uses to pay us dividends, to of course get rid of some of the debt the company has, acquire other businesses and so on, and buying back their own shares. There's a lot they can do with free cash flow, especially when the interest rates are very high right now. If they want to increase, if they want to reinvest in the business, you don't want them to go to the bank and get a loan for, I don't know, that's going to cost them so much because interest rates are very high. So they do have some cash to use for that kind of reason. Total return the last 10 years, it was 16%. Growth estimate for next year, 11%, and then 11% every year after that. 42% premium right now according to Morningstar, and $210 per share is where the price basically should be. Is not there right now. And just to kind of show you where the earnings is heading, it looks like it's, in terms of the revenue side of it, is actually from $23 billion to $25 billion to $26 billion in the next 2 years or so. And the EPS is heading the right direction. Well, was the basic heading the right direction, but I think there's a slight dip next year and then it bounces back again after that. Now, the second company we're looking at today is Qualcomm, which is a company that I own in my portfolio. It's a semiconductor company, 187 billion market cap, narrow economic mode, $167 per share right now. 2% dividend yield and payout ratio only 36%. They've increased, the latest dividend increase was 6%, and the 5-year growth rate of 5%. 20 years of increase in that dividend. So they now need another 5 years to become a dividend aristocrat. The annual payout right now is $3.40, and safety 80%. Profit margin 12%, return on equity 29%, and return on invested capital of 23%. Almost $10 billion of free cash flow, which is nice. Total return the last 10 years is 10%. Growth estimate for next year 10%, then 8% after that. 19% premium right now. $140 per share is where the price should be according to Morningstar. And looking at the revenue side of things, as you can see here, it's been heading the right direction, and then they had a bit of a dip. 2024 is coming back, $38 billion, then $41 billion. So it's bouncing back, and the same goes for the EPS as well. Now, the next company we're looking at today is Applied Materials. Again, another semiconductor company, 165 billion market cap. It has a wide economic moat. Price right now is just less than $200 per share. Dividend yield of 0.81. Payout ratio of 16%. Latest increase is 25%. 5-year growth rate is 12%. Dividend streak of 6 years in a row. Annual payout $1.60, and safety 86%. Look at this 25% increase reason, which is absolutely huge, but they have only been paying that for 6 years, which is not bad at all. Profit margin 27%, return on equity 48%, return on invested capital 33%. $7.7 billion of free cash flow right now, 27% total return in the last 10 years. Growth estimate next year 16%, 16% after that. Really expensive right now, 31%. Seems very interesting company, and I've talked about this company while it was actually undervalued, and right now, let's look at it, 31%, $152 per share is where the price should be according to Morningstar, but right now it's almost $200 per share. Now, looking at the revenue side of things, as you can see, $26 billion and 26.5 to 26.7 to 29, almost $30 billion in the next 2 years. And then the same thing goes for the EPS as well. So annualized, it's actually heading the right direction, which is absolutely wonderful to see. Now, the next company we're looking at today is Williams-Sonoma. Again, company that we talked about a lot when it was actually undervalued, and right now it's about 28% premium. 18 billion market cap, non-economic mode right now. Price right now $283 per share. Dividend yield of 1.5. Payout ratio 23%, and latest increase was 26%, which is absolutely huge. The 5-year growth rate of 16%. Again, really good. Dividend streak of 14 years increase in that dividend. $4.52 is what you will get. Safety 80% right now. 12% in terms of profit margin, return on equity of 49%, and return on invested capital of 36%. So profitability side of things, the company is doing really well. Less than $1 billion of free cash flow. Again, because it's a very small cap company, this is not actually bad at all, and it does cover the dividends. And total return, as you can see, actually 80% safety. So in terms of total return in the last 10 years, 17%. Growth estimate next year about 6%. Then after that's 10%. 28% premium right now. $220 per share is where they think the price should be. So again, in terms of revenue side of things, as you can see here, $7.75 billion. The next one is 7.7 and then 7.9. So it is heading the right directions, but it's not huge. And the same goes for EPS as well. Okay, from right now 14.85 to 15, then 16, which is absolutely fine. And final company we're going to talk about today is Colgate. This is one of the biggest companies in terms of consumer staples. 72.8 billion market cap, wide economic more, $88 per share right now. Dividend yield of 2.26, payout ratio only less than 60%, which is fine. Latest increase was only 4%. The 5-year growth rate of 3%. Dividend streak of 61 years of increase in that dividend. The annual payout is right now $2, 90% safety, which is quite nice. Profit margin of about 12%. Return on equity of 440, 55% right now. Return on equity of 36%. Return on invested capital, of 38%. Free cash flow right now over $3 billion, which is quite nice and covers definitely the dividends and so on. Total return in the last 10 years. That cannot be right. I think is okay. I need to double check this. Let's go back here. CL. Okay, let's go to Morningstar. Let's go to trailing. It must be 4.1%, 5.14. So it is, there's a point that's supposed to be there. So 5% in the last 10 years. Growth estimate for 9%. Growth estimate for the next year is about 9%. Growth estimate for the next 5 years, you're looking at about 8%. 15% premium right now. $77 per share is where they think the price should be. Right now it's $88 per share. So again, that's the companies that I want to share with you guys today. I'm going to show you from Sharia compliance side of things. Absolutely no issues. Like I've always said to you guys, do your own research, find out a bit more information about these companies. But these are really expensive companies right now. Okay, I will not be touching them anytime soon, including I own Qualcomm, so I will not be buying Qualcomm for a while now. See what happens in the market. Like I said, I'm genuinely expecting some sort of a correction. If I'm wrong, I'm wrong, but that's my feeling right now. And if it happens, we'll see. Of course, I'll take advantage of that and buy more stocks, inshallah. So yeah, have a wonderful day, inshallah, and join us in the Patreon account because it genuinely helps the channel. If you have not pressed like button yet, do it now, please, because it really genuinely helps the channel. Have a wonderful day. Assalamu Alaikum.